Hi, I'm Vitor D'Agnoluzzo. I'm a partner in the London office for Bain. I'm the leader of the interlock between banking and technology globally. So this team of business people, architects, bankers got together in a room to essentially draw up a more modern architecture and the path to release something to the market much faster than a full core banking transformation, and something that would enable you to at least test the proposition and make sure that this would work on an ever-increasing scale. So you don't need to replace your core from the beginning, but you need to prove out a model that delivers that $50 to $70 of cost per customer. Banks are looking to build teams with the best people, and the best people will want to work if you have modern technology. So it's a little bit of an insurance policy as well for banks that might not be prepared to move the whole load and the whole pool of clients to a new platform right now, but they don't want to miss the boat as well. They don't want to pause and look at what happens in the next 5 years, because if they start in 5 years, they'll be late to the game. The key advantages of a thin and cloud-native core are, for a lot of my clients, the speed to market and the flexibility for being a part of a composable architecture. I've seen banks like SEB, Lloyds, JP Morgan Chase going to the market and looking for a platform and ending up choosing VACore because they wanted that faster path to results, and they wanted to build on top of a thin core where they have the flexibility to choose what goes around it. Banks typically look at the decision to replace a core every 10 years, but they only take the leap every 20 years. And that gap is essentially because it's a very high risk, expensive, and long journey. Often transformations take longer than 5, closer to 10 years sometimes. And the bill for that investment envelope can very easily reach $1 billion, which is often driven by processes that were built to use people support. So processes that were built in another era, thinking of a large call center or operations center doing work rather than straight through processing, fully digital with more access to data for checks and balances, lower levels of risk as well and loss from better intelligence behind credit approval, etc. Migration is such a critical part of any transformation, but it's also often understated. If you try to sell the idea of a core banking replacement to a board just on the basis of innovation, top-line growth, accessing new markets, or a new pool of customers, that's not enough. The bank needs to see results also on the cost side. And that will only be possible once your current pool of customers are actually served by this more efficient set of processes that are sitting on better technology, and also technology that is cheaper to change. So while you can easily see that the investment in technology can be higher if you are buying new technology rather than on top of a fully depreciated mainframe-based set of software, the cost to change that software will go down. The business processes will also be cheaper because they're less reliant on people. So while every transformation starts with a lot of excitement and high ambitions, when you look at what the transformations actually achieve, very often these programs end up running on cost overruns and delays. And so banks settle for dilution. but the job is only done once you switch off the lights. So the mission is really to move your customers from legacy to the new stack, serve them with a much lower cost base, and be able to decommission the old. And that last part is a critical part of the scope. It needs to happen. So the banks that are successful are those where there's a strong partnership between business and technology, where business is open to making trade-offs in terms of simplification, and sometimes to just recognize that some of the products that were launched in the past and are on your back books today need to go. They need to be replaced. It's not worth it to replicate that complexity in the new stack. You need to let that go and have a clean, leaner new set of products for the future. But that will enable, at the cost of losing a bit of business, it will enable your higher efficiency for most of your business. So examples of where that partnership between business and technology really happened, and I think I mentioned Intesa, JP Morgan is another one. You have the transformation as really a CEO level priority, as opposed to something that starts more with the technology angle. So we see that the ambition in terms of revenue, cost, and technology modernization needs to be jointly taken by the GAC of a bank, with business and technology with equal representation. And I think a testament to that is if you just look at the investor relations reports from JP Morgan, Intesa, how much they talk about technology there and how much it's an important topic for the board and for the CEO.